In this particular presentation, I am going to teach you one small but very powerful option strategy. And this particular strategies, if you are forming, then you should have an objective first. So here we are setting an objective first. The objective of this particular strategy is to have a 1:3 risk reward. Means if I put 1 rupee into the risk, I must have a chance to win 3 rupees. So this risk reward objective, we are going to form this option strategy. So I am just going for the Reliance. Similar strategies you can form in any stock future which is having the options, active options. Similar strategy you can form in the Nifty index and Bank Nifty index also. So when we are forming this option strategies, it involves one three-step approach. First, we are gathering some information and doing some technical studies. Then we are forming option strategy with an objective of risk reward. And there also we need to have a close look in our employed capital. The amount of money what we are going to invest or going to block for this option strategy. No point of time more than 3% of your employed capital should be exposed to the risk. Means if this entire strategy has one investment of 1 lakh, so no point of time more than 3% of my capital should be exposed to the risk, 3000. So the third step, we are just calculating the theoretical profit and loss. Why I am saying it is a theoretical profit and loss? Whatever estimation we are doing with respect to the expiry day, on the day of expiry what happens, that is known as your theoretical profit and loss. But if you are not holding till expiry, if you are exiting the strategy much before that, then your profit will be different, loss will be different. And that can be calculated with one advanced option strategy software, which Smart Finance has. So without going into the software, just we'll look into the theoretical profit and loss, and we'll just derive some conclusion that how much capital is required, how we have been protected, and all information. So this kind of strategies, when you form, you should have a definite objective. And before I proceed to the session, I just want to make one small announcement. We have scheduled one month option strategy course at a very nominal price of 590. This course is Master Option Strategy course. Starting from 22nd March to 21st April, you have few sessions of theoretical discussions, English and Hindi. 22nd, 6 sessions are being scheduled for discussing 14 hybrid option strategies with a definite structured approach. And then after you will have a practice on WhatsApp, we will be giving you different option strategies and we will be just analyzing those strategies, why it is being taken. So if you are interested to join this program, just visit our website smartfinancein.com, visit the seminar link, and here the registration button is being given. Just pay 590 and register yourself. So now I will be moving to the strategy discussion what I have been showing you. So here my objective is to form an option strategy having 1:3 risk reward. So here I'm just gathering some information and do some small technical studies. Here I am not using any moving average concept. Here I am not using any of the statistical indicators. I am using a very valid concept of volatility. Annual volatility of Reliance is at 25%. Monthly volatility is 7.39%. So how this monthly volatility is being derived? So this is the annual volatility divided by square root of 365. So whatever the result you got in this, you are multiplying square root of 30. So this will give you the monthly volatility. And March month, today I am recording it on the 11th March, and in this entire month of March, it has made a high two low oscillation. So it has made a high, it has made a low. The difference between the high to low is 5.89%. March low was 1224.25. So I'm just taking this 1224 as a reference price, the low as a reference price, because I am at a higher zone now. Currently it is quoting at 1293 or 94 level. So since it is in the higher band, so I'm just taking the monthly low and going to apply this monthly volatility and Fibonacci principle and to derive some price points. So I have just multiplied the 7.39% with 1224. I got a price range. That price range 61.8% of retracement if I am deriving, and it is coming to 1280. So if I am taking 0.786 retracement, it is coming to 1295. I am currently at 1294 level. So I have crossed the past death zone of the Fibonacci, 61.8. I am just few price points below the 0.786. If this crossover happens, then I may go for 1.618 retracement, where my one cycle of uptrend will be get completed. So that price is coming to 1370. That means I am here multiplying 1224 multiplied with 7.39%. So this comes to around 90 points. In this 90 points, I am multiplying 1.618. So it will be 130 plus points I will be getting. So that 130 plus points I am adding to 1224. 1224 added with 130 plus points, whatever I am getting here. So by this process, I am just deriving 1370. So if you just take a calculator, you will get the exact picture. So these are the investigations I did, or some technical informations I just gathered. Now coming to the step 2, where forming a option strategy. So no point of time, 3% of my employed capital will be exposed to the risk. That is my first criteria. I should have a 1:3 risk reward. And you can, with this objective, you can explore number of combinations you can form. But here I am just going with an approach of theta positive and a delta near zero approach. In this, what I am doing here, I am just buying a future here, one lot at 1293. I am buying one 1320 put option, which is deep in the money put option at 43. So this particular put option is having almost 27 rupees of time value. So if I just less the 27 rupees here, so here 6 and 1. So 16 rupees of time value and 27 rupees of intrinsic value. I am going with a deep in the money put option. I am selling a strike above this put option. One call option I am selling to make it as a covered call, and that strike should not be same. It should be higher than 1320. So I am choosing 1340 call option. So 10 rupees 75 paisa I am selling it. So by this process of selling, I am reducing my net time value liability to 5 rupees. So this is what I am doing. This combination covered call with deep in the money put option. So this combination has formed. Here the objective combinations are many. However, we have formed the objective of theta positive and delta near zero. Post that, our most important phase of analysis, which is our theoretical profit and loss estimation. So maximum loss in this strategy will be 2625 if the Reliance expires at or below 1320 at the March end. So if Reliance is, just say 1320 it is expiring, so in the future 93 to 1293 to 1320, so you will be making, so 7 here and 11 9 are 27 rupees you will be gaining here, and same way 43 rupees you will be losing from this 1320 put option, and 10 rupees 75 paisa you will be gaining from the 1340 call option sell. So net off, if you can find out, you'll be having a maximum loss of 2,625. If Reliance closes above 1340 by March end, so your theoretical estimation of the profit will be 7375. So if you just take it to the risk reward, you are getting 1 is to 2.8. 2.8. So this is the risk reward you have been set. Break even point, the price point where I will not have loss and also no profit, that is 1325.25. If it is closing above 1325.25, you will neither have the loss nor you have the profit. So these are the theoretical estimation happened. Now coming to the capital requirement and other parts. So here the net capital requirement will be 1,78,000. Maximum loss 2626. So risk is 1.47%. So your entire capital risk is 1.47%. Profit is 7375. So based on your entire employed capital, if the profit comes to you, you'll be getting 4.14%. So here too also 1 is to 3, 1 is to 2.85 ratio you maintain. You have a risk of 1.47, you have a reward of 4.14, and on your total employed capital. So I have not taken the brokerage and taxes that you need to factor from your end. So since you have a future buy, you need to maintain a M2M also. So this, if the price fall back, then you need to meet the M2M also, mark to market margin. So here, if the Reliance fall back to 1245, which is 0.236 retracement drawn from the March low, that is 1224, with annual volatility, monthly volatility 7.39%. If it falls below 1245, it is not worth to hold this strategy. Better book the losses and come out. So this is the simplest approach to form this kind of strategy. You might be thinking that profit is only 7,000 and the loss is 2,000. So employed capital is 1.78%. So what is the major benefit in strategic trading? Imagine the situation, similar kind of trade, you have done 10 trades and only 5 you got a success and 5 you got a failure. So each 5 successful trades with an average gain of 4.14% or 4% you can say. If 5 trades are being successful, you are getting on an average return of 4% on your employed capital, 20% return you are getting. And if 5 trades are failure, they are also at 1.5% of loss on your employed capital, you'll be getting 7.5% of loss. So you can say in a month, if you do 10 trades and having this kind of 50-50 of accuracy, still you make 13%, 12.5% of return per month. So which is a very, very promising return. If you just take it out, another 2% out also, 10% return per month, if you can able to make it also, that itself is a great return. So do not look into this factor of the losses and profitability. Rather, one structured approach of implementing the strategy makes your portfolio very healthy and you make excellent gain over a period of time. So only thing is that you need to learn when to implement which strategy and what will be the objective of a strategy. Like everything has one objective. You are an engineer, you have an objective that you should learn best technologies. If you are a doctor, you have an objective that yes, I can cure the patients. Same way, if you are a trader, you must know when to implement what kind of strategy and how to take benefit of that. So we have just impacting those values on the traders. For that reason only, we have been conducting regular programs on options on various technical subjects and conveying the idea that how you can implement those studies in your practice. So if you are convinced with this fact, do not delay and register for this coming program, Master Options Strategy course, which is starting from 22nd March, ending on 21st April. And it is a great course. You will learn many different strategies and you will also learn how to implement those strategies in a more structured way. For registration, visit the seminar link and register. You must view the reviews given by the traders who has joined our earlier program. Traders, those who have joined our earlier program, what they feel about this kind of program. You have plenty of reviews. You must go through these reviews. Just convince yourself, yes, whether this particular program is worthwhile for us or not. One very strict warning here. We have also given who should join this program. If you are just a intraday trader, then it is not going to benefit you. It is not going to benefit the intraday traders. It is only for the traders, those who wants to work on the risk reward model. It is only for the traders, those who have a thought that yes, I can utilize the opportunities exist in the option strategies. Only for those traders it is valid. So enroll for this program as soon as possible so that you will get a seat, and once the seats are adjusted, will not be in a position to providing the any opportunity to join this program. If any query, you please send us the WhatsApp message. On the same page itself, we have given the WhatsApp link. You can click there and send us the message. We will be clarifying more on this program. Thank you very much.